morning. Hey everyone, my name is Andrew O'Neill. I am a risk guy. No one likes the risk guy, always asking what might go wrong, worrying about what might go wrong. But I actually believe strongly in the potential for blockchain technology in financial markets and Ethereum specifically. And I really think what is important to enable that adoption is first and foremost educated conversations around risk and how we can work to mitigate those risks in a robust manner. The way in which I participate in that is that I lead digital assets analytics at S&P Global Ratings. We are an old TradFi institution, been around for 150 odd years. We do risk assessments on financial securities, bonds and public markets, funds, as well as now assessments on stablecoins and ratings on tokenized money market funds. And so what I wanted to start with was a little bit of context as to why I actually think there is significant potential for the adoption of blockchain technology and Ethereum specifically. Because we hear a lot about tokenization as if it's like a self-fulfilling prophecy, that the number must go up. But I think there's actually real reason driving this. When we think about the current technological state of financial markets, we're talking about technology that has broadly not been updated since the 80s. This is now changing. Markets are being modernized, and they're being modernized in a very specific context. We're seeing significant geopolitical shifts. We're moving away from a unipolar US dollar-dominated system towards a multipolar world where there are competing nations, may wish to have some control over the systems that they use for their trade payments, and even where, between friends, having all of one's gold held at the Federal Reserve Bank of New York is starting to be something that some European nations are questioning. So the need for open infrastructure that's secure and credibly neutral is obvious. At the same time, we're seeing the rise of AI. We're seeing transition towards new types of energy. And we're also seeing that a lot of the innovation, a lot of the success stories in those areas are coming from private companies. There was a time when a company would take on a certain amount of success and go public. That is now happening a lot later in a company's life cycle. More companies are staying private for longer and looking to borrow and finance themselves through private credit markets. They are issuing fewer bonds on public markets. They're probably beyond the capacity of what they can get directly through a bank. They are accessing financing that is coming from specialized investment firms through private credit markets. That provides tailored products that suit borrowers very well, that suit very specific investors very well, but it does lead to a risk of markets fragmenting, of borrowers not being able to find someone to refinance with if their original lender is no longer willing to refinance. Now, solving for the unification of liquidity is a problem that crypto markets and DeFi markets specifically have been thinking about for some time. And some of the infrastructure that we're seeing coming out of that could play a key role in that path. But beyond just unifying liquidity, tokenization also promises to accelerate the pace at which value is transferred in markets. And that is really a key part of the early adoption cycle. To explain that, what does that mean? So when we think about transactions in financial markets today, I'm selling you a bond. I'm going to send you that bond through some intermediary using some IT system that's proprietary to them. And you're going to send me a payment from your bank through multiple correspondent banks before it reaches mine. Two separate steps happening at different times on two different systems. By tokenizing an asset on a blockchain and bringing the cash leg of that transaction onto that same chain, we enable instant atomic settlement. That means lower waiting times, lower costs, lower inefficiencies, reducing counterparty risk exposures during those settlement times. So that's clearly attractive. And we've seen assets being tokenized now for years, but we've not really seen this take off yet. And why is that? So in the earlier talks today, you've heard a little bit about the use of private networks. And a lot of early adoption and tokenization has happened in those kind of closed gardens. So one question is how to link up those gardens, whether that's moving everything to private markets, or more likely building tools to link different networks to public networks and to each other. But you also need agreement on the types of tools you can use for a cash leg for an on-chain transaction. There are three broad types. One is a digital currency issued by a central bank, which might work quite well for transactions between banks who are linked to that central bank. You have tokenized commercial bank money that, again, can work quite well for transactions between customers of the same bank, but potentially not so well suited for more open networks. Privately issued stablecoins, if built in a sufficiently robust way, can help to bridge that gap to more open systems and actually unlock some of the benefits of this. Because the most effective asset tokenization platform brings no commercial benefit to its users if you don't enable the second half of that equation and bring that cash payment on chain. So when we hear about the Genius Act in the US, that is what's really going on here. Genius Act is the stablecoin legislation that has passed the Senate, next going to the House of Representatives. That is the big unlock. Having US-issued, regulated stablecoins that institutions can confidently use and trust when bringing financial products on chain. So what's that adoption going to look like? So we see this playing out in three phases over the next 10 years. First, the low-hanging fruit, the things that are already happening. Collateral mobility. Financial institutions borrow and lend against collateral, most often sovereign bonds. Those are the early issuers of digital bonds that we're seeing in the digital bond ratings that we're assigning. We're also seeing the early adoption of tokenized money market funds that I'm going to get to in more detail in a minute. And in terms of stablecoin payment, the use case of stablecoins for cross-border payments, removing all of the friction and cost that exists in today's payment systems, or I should say yesterday's payment systems, is a really straightforward unlock and first use cases for people using stablecoins. Now, when we start to see companies using more stablecoins for payment, they will then have a need to borrow on-chain. And this is where we start to see the use cases for tokenization expand beyond the very safe and boring short-term government obligation-backed transactions we're seeing today. And indeed, we're seeing early use cases of this phase two. So when I put 2027 there, maybe I was a bit cautious, but I think there will still be, it will take a little bit more effort for this to actually scale. I know Paul from Morpho is speaking after me, and there were some interesting developments on the Morpho protocol earlier this year when they worked with Apollo to make a tokenized Apollo private credit fund available for borrowing for investors in that fund. And that's just an example of how, for more complex financial instruments, some of the infrastructure of DeFi can actually be used to generate some pretty interesting products from an institutional investor perspective. But we're also going to see the evolution of tokenization as more and more things are coming on chain, converge and intersect, I should say, with other technological developments. and in particular, the rise of AI and how it applies in asset management, so on the investor side of capital markets. Because as more and more assets are tokenized, asset managers will be building their portfolios on blockchain rails. They will be rebalancing their portfolios using smart contracts. They will be individualizing portfolios for investors using AI agents and using, again, smart contracts for rebalancing and enabling easier access to alternative asset classes for smaller investors who today aren't able perhaps to access some of the opportunities we're seeing in private companies that are leading some of the growth trends of today's markets. But I want to focus today on phase one. What we're seeing today. So when I spoke at the ETC last year, I talked about tokenized money market funds as being the story of the time. I think 12 months on, it is still very much the main story that we've been seeing on the rating side, but it's still very early. And I would say we'll be very early so long as we're still looking at a y-axis here with the letter B rather than the letter T. But still, we've seen 7x growth in the last 12 months and some pretty interesting trends within that. What do these funds enable? Basically, they're backed by boring government bonds. They enable investors to move in and out of those funds quickly on-chain using stablecoins. So who are the investors? Who's actually buying this? Well, the early investors are actually mainly DeFi protocols. And particularly if we look at the pickup here in March and April this year, that is primarily driven by the Sky protocol, formerly known as MakerDAO, investing a significant chunk of their balance sheet, I think by now about $1.5 billion, in these tokenized money market funds. So why are they doing that? If you're familiar with Sky or MakerDAO, they issue the USDS DAI stablecoin. Part of the mechanism for maintaining the stability of that coin relative to the dollar is that they provide liquidity to swap USDS for USDC. So holders of USDS can move in and out of the Sky protocol and into USDC. And so what they need to do is provide sufficient liquidity to support that mechanism. They hold some USDC, but they also need to generate yield on the assets that they're holding. So they need safe investment products that they can move out of quickly. Until very recently, they were doing this by investing in T-bills that they held off-chain, which indeed are a liquid instrument, but certainly not something that can move at crypto speeds. That's the promise that tokenized funds bring. So here we're looking at the liquidity mechanism of the Sky protocol, comparing the USDC in their peg stability module, so USDC that they're holding as liquidity to support swapping for USDS, and their exposure to tokenized money market funds. And the really cool thing that this has enabled is that they're able to completely automate the management of this liquidity position. They set their USDC to be within a target range of 20 to 30% of total assets. If they fall below 20%, smart contract sells some tokenized money market funds, raises USDC. If they're in excess of their 30% threshold, they use the excess to buy some more money market funds. Only having that on-chain allows it to be automated, allows it to happen in real time at crypto speeds. Now, this is pretty cool for a DeFi protocol. It is pretty niche in terms of overall volume, but actually this promises some very interesting applications in much more general corporate treasury management, as well as in the liquidity profiles of various types of financial instruments, such as securitizations. So this kind of thing gets me really excited. The ability to track this stuff on a dashboard is something that, as a risk analyst, gets me really excited too. But just an insight into how these funds are being used today. But I started by saying that we really need to have educated conversations about risks. I wanted to spend some time going through the risk considerations that we see when these traditional products are coming on chain. So starting on the right over here, we've got a couple of investors who want to buy this tokenized money market fund. They may be investing on different chains. They may be using different stablecoins. They are interacting with a mint and redeem contract on the relevant chain, usually with some kind of permissioning enabled to ensure the fund manager meets their KYC obligations. So they're investing in the fund in stablecoins. The fund manager will use an on and off ramp provider to swap that for off-chain US dollars and then buy the off-chain T-bills. When the investor wants to redeem, the whole thing happens in reverse. The fund manager sells the T-bills, pays the dollars and to the on-ramp provider, and the stablecoins flow out to the investor. So we've got three main categories of risk here. First, stablecoin risks. One of the most important things to note is that all these instruments are still going to be denominated in dollars. There's no such thing really as a fund that's denominated in, say, USDC. Stablecoins are a tool for making payments on a dollar-denominated asset. So the way in which these funds are structured is that indeed investors can choose, for example, USDC as their preferred means of payment, but the amount that's owed to them is calculated in dollars. The fund itself is not holding on to any stablecoin. It is moving that off-chain and buying T-bills. That may change one day if the US issues their bonds on-chain, but for now, that's the mechanics. So then you've got the risk of this on and off-ramp provider. Are they exposing the fund to any price sensitivity? Is there any risk or exposure to that to the risk of that counterparty going insolvent? Step two, the flow of information between the on-chain and off-chain environments. So when an investor puts $100 into the smart contract, how many shares should they get? If they want to redeem $50 or 50 shares, how many dollars should they get back based on the valuation of the fund? How does that valuation information flow from the fund manager into the smart contract? Is that an Oracle risk? Is there a centralized party operating the tokenization platform? Again, this is a case-by-case analysis and understanding the dependencies that are involved and what can happen if, say, there is an interruption in a data feed. And last but certainly not least, we think about cyber risk, we think about the operational resilience of the setup. We look at the division of roles to address the risk of any particular role being compromised. We look at the security around the wallets that access these smart contracts, that can modify these smart contracts. And perhaps most importantly, we look at the underlying chain that is being used to support these transactions and how interruptions with that chain would be considered under the documentation of the security that we're writing. Because this is what it all comes back to. You will never get to a situation where you can eliminate all risk. The question is understanding what are the risks and how can we contemplate different risk scenarios and how a long-term transaction will operate in those scenarios. So let's focus on Ethereum and what we need to think about when we're thinking about risk and the use of Ethereum. If we're thinking about an interruption in the chain, if we're thinking about the inability to actually finalize a transaction on Ethereum mainnet, a key consideration is, could there be a sufficient number of validators that are offline at once that could prevent the ability to reach consensus and reach finality on-chain? That number 1/3. Start thinking about different thresholds, a bit higher than 1/3, or much more serious things might happen. But already, if you have 1/3 of validators compromised, you're in a situation where, until that's resolved, you cannot achieve consensus. So that's already the first concept to look at. We look at the concentration of stake. Who's running validators? Now, this is actually a picture that's improved since last year. Concentrations in Lido and Coinbase in particular have decreased. Now, you could spend a whole talk talking about whether you should really think about Lido as a single exposure. Probably shouldn't, but there is still a commonality of at least smart contract risk that needs to be considered there. And then we look at clients. Execution clients, consensus clients that the validators are operating. What happens if there's a bug in one? Go back to May 2023. This was one of the very rare interruptions in Ethereum achieving finality because of a client bug. Now, this lasted a few hours, but the reason that it's a problem is that if you have the same number of, if you have a large number of validators that are using a client that happens to have a bug in it, then you are exposed to even if you have diversification of the underlying validators, you have the risk that they're all offline at once because they're using the same software. Now, you can look at decentralization in many ways, but it's key to understand that from Ethereum mainnet perspective, decentralization is the way in which risks get mitigated, and institutions looking to use Ethereum mainnet need to understand how to monitor that, need to have a plan for what to do if someday consensus client concentration reaches 100% again, or 75% of validators are being run by the same company. These are risks to monitor. They're not risks that can be excluded. But for many use cases, Ethereum mainnet may not be the most optimal solution, whether that's for throughput, for privacy solutions that Paul was talking about just before. L2s may provide a better fit for some use cases. And when we're looking at risk in L2s, it's not really about decentralization, because L2s by design are a more centralized construct than L1s. You may be familiar with the L2 Beat platform and their risk pie charts that can compare different L2s. If not, check it out. This is just a way to start thinking about the different risks that we see in L2s. Because what are we thinking about? Ultimately, the L2, to a point, benefits from the security of Ethereum mainnet. Transactions are being sequenced on the L2 and sent by a proposer back to Ethereum mainnet. There's a validation of the state of that network. The data of the network is made available. How? The key question that we're looking to address here is, if there's a central entity performing a key role in this setup, a centralized sequencer, a centralized proposer, the centralized sequencer, centralized proposer being the same entity, a core development team of 5 people who might have another brilliant idea and go off and do something else. How do users of the chain manage to continue its operation if that central dependency becomes a risk? If that entity is no longer able, for whatever reason, to perform the role that they're doing. So are we comfortable that the state of the network is valid? Are we comfortable that people can, or users of the platform can permissionlessly operate the sequencing, can permissionlessly bring transactions back to the L1? The example here of Base is one weakness highlighted by L2Beat, which is just around the ability to exit if there is an upcoming upgrade, so a window of time during which users can upgrade. But that's an important concept as well, the idea that you're using a smart contract through this L2 that can be changed by someone, that someone has the keys to. So how do you get out if it's going in a direction you don't agree with? Now, there are two types of ways in which the validation of these networks is achieved, either through optimistic setups or zero-knowledge setups. The optimistic setups are, I will say from a very non-technical background, simpler. Zero-knowledge is very advanced cryptography and is harder work. So to date, most of the adoption has happened on the optimistic side, but progress is ongoing on the zero-knowledge side. And that may be where we see adoption from institutions or companies who are more concerned with privacy. I showed you the Sky protocol's full liquidity picture a few minutes ago. I don't think a bank would be particularly appreciative of me standing here and showing you a live picture of their liquidity position. Paul was talking about how companies need to protect the information about their supply chain, about their financial position, the prices they're paying. So transparency can be good. It's not necessarily suited for every use case. So we've seen banks announce that they're working on L2s. We've seen JP Morgan deploy their new tokenized deposit product, JPMD, on Base. Because these L2s provide some of the openness of crypto, they provide most of the security of the Ethereum network, and they also come with centralization that can be identified and mitigated. Now, I don't know what JP Morgan's plan is if there's an issue with Base, but it's recreating a situation that is more comparable to the existing world, where you can never exclude operational risk. You can never exclude the risk of a system going down, but you can write contracts that define who is responsible for remediating a situation that hasn't worked out. Those contracts are underpinned by a legal system, and that is the context in which institutions operate, and institutions will seek to adopt these tools. So it's not all Ethereum. Other platforms are emerging that might be more permissioned, might be more centralized, may still meet the needs of financial institutions. It's very early days for all of them. Ethereum has a significant head start in terms of the liquidity that's available there today. But what's really going to drive adoption and really help Ethereum adoption, in my view, is honest, informed conversations about risk and about how risk can be captured within the context of a financial market transaction. So with that, happy to take any questions. Or insults. Last year someone had an insult. Yeah, I think we've got one here.
Hi, thank you for the presentation. Actually, I just saw the last couple of minutes of it, but I'm interested in learning what do you think about, you mentioned Ethereum, already have some traction, having a lot of liquidity on there, lots of real-world assets tokenized. Do you think for institutions, Ethereum looks much more safer than other like alternative blockchain networks when it comes to tech, operational risks, or just risks in general? Like for example, Solana or some of the new wave of Ethereum killers.
I'm not sure I like the term Ethereum killers. I think when we looked at the funds that we've rated, we've seen them issued on more than one chain, but with Ethereum being at least the largest initial area where activity has happened. So I think institutions will look to meet investors where they are. They're not going to be ideological about that. At the same time, you have to know that a lot of the private networks that institutions built were built to be EVM compatible. And that wasn't by accident. When you're thinking about operating systems in an institution, you don't want necessarily to develop something that's entirely proprietary, that's based on some coding language that you've got one clever employee who created himself. You want to be able to dip into the talent that's out there. You want to have a wide range of available developers, for example, who are well versed in the technology and so able to come in and bring improvements to your institution, or even just replace the person you have who's left. That becomes a lot harder to do if you're doing something that's highly specialized and based on your own technology. So that is why a lot of the early adoption, I think as of last year, was about half of the use cases done on private networks were actually done on EVM compatible networks.
Hey, thank you so much for the talk. This was great. Wondering, are you planning on providing some ratings for different assets, and how are you currently supporting institutions in making better informed decisions? Thank you.
Sure. So we rate tokenized money market funds and digital bonds. They're the first kind of traditional things that that we've rated on chain. So in terms of digital bonds, we have I think about 20 issuances outstanding, most of them from government issuers. We have 2 ratings on tokenized money market funds, and then we also publish ratings on, stability assessments on stablecoins. So we publish reports on 12 of the largest stablecoins, mostly US dollar pegged, but also a couple of euro ones, and both centralized and decentralized. That's why we're quite interested in the monitoring of the Sky protocol in particular, as we publish an assessment on its stablecoin USDS DAI. So that's the beginning, and then we're part of Project Guardian, which is a kind of group of institutions led by the Monetary Authority of Singapore that's looking to establish global standards for the use of blockchain technology in financial markets. So there's a report published from that at the end of last year, and I'm sure more to come. I think we had one over here. Oh, no, oh, sorry. No more time for questions, I'm told. So thank you very much, and enjoy the rest of your day.